Hello and welcome to the latest Moneymakers Weekly Investment Trust podcast. I'm Jonathan Davis, the editor of the Investment Trust Handbook, and your host for this weekly review of all the latest news and developments affecting the investment trust sector. My thanks to JP Morgan Asset Management for agreeing to sponsor the podcast, which as a result will now remain free for the foreseeable future. Moneymakers is an independent research and publishing venture with a mission to explain and inform. But I must remind you that for regulatory reasons, nothing you hear from any speaker today should be regarded as constituting individual investment advice. It was a relatively quiet week for news this week, but a good one for global equity markets, with the all-world index hitting new all-time highs, and most major markets, though not the FTSE 100, up nicely over the course of the week. Bond yields also fell, though a little firmer towards the end of the week, and that's on both sides of the Atlantic. Best performing markets were once again the Hang Seng Index and China, which were up more than 5%, whereas the Nasdaq and S&P 500 are up between 1.5% and 2%, Japan up around 1.5%. And although the FTSE was down, as I've said, by a fraction, dragging down the all-share as well, of which it's the major component, the 250 and the smaller company indices were up around 0.5%, perhaps continuing this rally that we've seen in UK small-cap equities. Is that a foretaste of more to come? We'll find out. The Investment Trust Index, meanwhile, was up around 0.5%, and the average discount across the Investment Trust Index is now around 13.5%, a little wider than it was at the end of last week, but still positive progress from where we were a few weeks ago. Notable too that commodities were in good form this week, with oil, copper and gas all up, but also silver, platinum and gold were also showing well, up around 2% on the week in the case of gold, and more like 5-6% in the case of silver and platinum. What does that reflect? Well, I think it's a combination of residual concerns about inflation and the geopolitical risk, while at the same time the global economy is still performing better than many had anticipated, which leaves the outlook for interest rates, I would say, still hanging in the balance. The latest inflation figures from the US were a little better than expected, and that's prompted new expectations of imminent rate cuts, or at least rate cuts in the autumn. But I think it's too early to say for sure that that's where we are heading. Gilt prices, meanwhile, were up across the entire maturity spectrum. So, turning to specific news, I say there were not a lot to report this week in the investment trust sector. A couple of trusts reporting annual results. That's in BlackRock Smaller Companies, ticker BRSC, and Asian Energy Impact, ticker AEIT, whose shares finally came back from suspension this week after publishing its much-delayed latest annual results, along with an NAV update for the first quarter, both of which negative numbers, not entirely surprising. This trust's shares now trade at just 19 cents, well down on their launch price. There were also interim results from Aberdeen Equity Income, Polar Capital Global Healthcare, Baillie Gifford European Growth, and Tritax Eurobox. Two standout performers here being Polar Capital Global Healthcare, ticker PCGH, which returned a 16.6% NAV total return for the 6 months to the 31st of March, and Baillie Gifford European Growth, ticker BGEU, making a welcome return to some sort of form with an NAV total return of 20.2% for the same interim period. On the news month, a lot of minor announcements from alternative trusts, some updates as well. I've already mentioned the fact that the shares of Asian Energy Impact have resumed trading, but the outlook there is obviously pretty bleak. We also learned that the proposed merger between Henderson Eurotrust, HNE is the ticker there, and Henderson European Focus, HEFT is the ticker. It's been announced that the terms of the proposed merger between these two trusts has been sweetened somewhat, with a cash exit increase from 5% to 15% and some other changes. This follows the news that there was another third-party approach to Henderson Eurotrust proposing an alternative combination. But that has had the effect of improving the terms of the deal that was announced earlier. We also learned that the merger of UK Commercial Property, ticker UKCM, and Tritax Big Box has now become effective. And B-Box, that is Tritax Big Box, making a positive-sounding comment about uptick in levels of activity in its development pipeline. Elsewhere, we also heard more from Pantheon International, ticker PIN, Private Equity Trust, which gave more details about its proposed capital allocation policy, which will see a rising percentage of its surplus cash flow being used for buybacks, dependent on how wide its discount level is at the time. And that follows its earlier announcement of a very large share buyback program, taking the lead here in the private equities sector. Looking at the performance of the investment trust sector, as I said, the index was up around 0.5%, but there were some notable movers on both sides of the ledger, as so often. Heading the list of fallers this week was Chrysalis, the early-stage growth capital trust, following reports of trouble at its largest investment, WeFox, an insurance company where there have been rumours of that it may be running out of cash and possibly facing a severe cash crunch. Chrysalis has put some more money into that investment to help shore up its position. And this despite the fact that there have been a number of positive notes coming out about Chrysalis from its house broker and others. By chance, this week I did have the opportunity to talk to Richard Watts, who is one of the co-managers of Chrysalis, which, as you may recall, has recently moved away from Jupiter, where it was housed for 3 years or so, and is now being managed by an independent boutique firm, of which Richard Watts and his colleague Nick Williamson are continuing as the portfolio managers. So this was a timely conversation about the outlook for the trust, though unfortunately it was recorded before this news about WeFox came out, and didn't have a chance to discuss that in detail. Nevertheless, it's a chance to take the temperature of the growth capital sector, which has been rallying after a very tough couple of years as interest rates rose. Before I talk to Richard Watts, though, there is another conversation I had this time with Sandy Nairn, who is the Chief Investment Officer of Global Opportunities Trust, ticker GOT, and his colleague Alan Bartlett from a specialist investment advisory firm, Goodhart Partners, which now has a formal relationship as an advisor to Global Opportunities Trust. You may recall this trust not so long ago changed to a self-managed structure and now sits in the flexible investment trust sector rather than the general global equity sector where it was before. It has a very interesting mandate. Some of you will know that Sandy Nairn and I have collaborated on books in the past, so I've taken a keen interest in this one for a number of years. And I talked to them about what they're trying to do and the distinctive investment approach that they have, which is targeting positive NAV returns with low volatility, but somewhat different in detail from the similar sounding approaches that you will find in trusts like personal assets and capital gearing. So something to ponder there, very interesting conversation. If you are a subscriber to the Moneymaker Circle, you will be able to find all the details of the news this week. And as always, we have a new investment trust profile, this time featuring CQS Natural Resources Growth and Income, ticker CYN, and that will be followed in future weeks by RTW Biotech Opportunities and CT Private Equity, as well as, before too long, an updated look at Scottish Mortgage, ticker SMT, following its substantial changes that will be made to the board last year. Looks interesting time to take another look at this largest equity trust in the investment trust universe. So my first question to Sandy Nairn, the investment director of the Global Opportunities Trust, and his colleague Alan Bartlett, when I spoke to them this week, was about the global market situation. Sandy published a book 3 years ago called The End of the Everything Bubble, which predicted a significant sell-off in both equities and bonds, which duly occurred in 2022. But since then, equity markets, particularly in the US, have been stronger than many expected, while bond yields have remained elevated at around 4 and 5%. So, Sandy, the question is, I think you were expecting the market sell-off to be even worse than it was. Where are we? Have we just seen a deferment of this sell-off that you were talking about, or are we still waiting for it, and is it imminent?
So I think in some ways it hasn't changed, and in other ways a lot has changed. 2 or 3 years ago, we wrote up in detail, the views on the so-called everything bubble, which seemed to be fairly clear in the sense of historically high valuations and the very unlikely path you would need to justify those. And that conditioned how the portfolio of the trust was structured. Bonds were expensive, private equity was expensive, public equity was expensive, debt was expensive. So right across the board. And in the early stages, some of what we thought happened would be fulfilled. And then The big thing that sort of shifted was the bulge in inflation that came through post-COVID naturally tailed off in an arithmetic sense, which gave a second wind to the markets in the sense that we're going to get low interest rates and we can have sky-high valuations. Sovereign debt has corrected a bit. That's the bit that has changed. And within equities, there's been a number of rotations, but the generality is that public and private equities remain pretty expensive. And therefore, although there's been significant changes within the portfolio, the general defensive thrust of it hasn't changed.
And what would it take to change that?
So if you start off with bonds, they're no longer obviously expensive. They might be, they might not be. It depends on policy reactions. If inflation comes down and sticks at 2, then they're in the right ballpark. So that's one of the things that has changed. But equities remain high by historical standards, so up with 1929 and the TMT bubble. They haven't been more expensive in aggregate, although, underneath that, there's, I think, varying pictures. So what is the escape trajectory? The only one you can get is you have unprecedented productivity growth. You need economic growth to justify this, to pull the earnings up. And even with things like AI happening, which is very positive, that doesn't seem to me to be a practical way of getting the productivity growth you would need. So the problem is we're just overvalued.
And Alan, do you have anything to add to that?
I think there are a lot of structural impediments to a bullish view on economic growth that go even further. Whether it's political risks, reshoring post-COVID, increasing spending on defense, the challenges of funding healthcare, demographics being the huge impediment to improvements in longer term growth. So I think, Sandy's comment about the unlikelihood that artificial intelligence can plug the gap on productivity growth is sort of made worse when you think of the other side of the ledger, all the things that have to happen over the next few years that sort of mitigate in the opposite direction. Fiscal deficits, taxes going up. It all suggests structurally lower economic growth over the very long term, and the requirement to adapt to it ultimately.
So let's go back then to what you're trying to do with this investment trust. You adopted a new structure, a self-managed trust a couple of years ago, and a new mandate, essentially. So what actually is the shape of the portfolio at the moment, and what changes have you made recently to reflect your views about where we are?
So when the trust was launched in 2003, it had a pretty flexible mandate in terms of what it could do in cash and so forth. And historically, that should have been enough. And then we had the global financial crisis and then QE and all the things that happened, culminating in the, as we termed it, the everything bubble. And as we saw that unfolding, we looked at the portfolio and thought, within the investment mandate we have, we can't actually protect this enough because we've never had this before. So that was the reason for widening the flexibility to allow us to invest in the instruments that can give not just protection, but potential upside in the conditions that we see.
In simple terms, there are sort of 3 pieces to managing the portfolio. The first, obviously, is looking for ideas that are going to make money. And so trying to find investment opportunities that will make real absolute returns over the longer term. The second piece is trying to combine different investment ideas in a way that creates a more resilient return stream. So a portfolio that can perform in a range of different scenarios. And I think that one of the things that really differentiates the strategy behind the Global Opportunities Trust is that we also take responsibility for the overall risk profile of the portfolio. So the third leg, if you like, is take responsibility for where we think we are in a global valuation and economic cycle, with a view to how much absolute risk are we wanting to take in the portfolio. And it's the calibration of those 3 things really that drives the strategy in aggregate. So whilst we are macro bearish, if you like, and certainly very skeptical about valuations at the moment, we are looking for investment opportunities that will make money. We're just trying as much as we can in the overall portfolio to extract the global valuation risk and not have broad economic procyclicality in the portfolio. So we have to be very discerning, if you like, in what we actually invest in, because we're not trying to have correlation with the global equity market, and we're not trying to have correlation with sentiment towards global economic growth. But we have a number of exciting and interesting individual investment ideas that we think make money over time. So the objective is to make money. somewhat regardless of whether equity markets are going up or down.
Right. Well, that addresses my next question, which was, what kind of investor do you think would be interested in investing in Global Opportunities Trust? Obviously, Sandy, you have a significant personal stake in this trust, so if you like, it's a kind of multi-asset venture for you. What kind of investors do you think would be interested in the trust? And they have to presumably share, to some extent, your view about the world.
Yeah, I think what we've tried to do is explain clearly what our view of the world is. And then this portfolio, this trust, is reflecting that and positioned to gain from what we see and then be dynamic and change as things unfold. So yeah, if you were diametrically opposed to what we think, then you wouldn't want to own the trust. I mean, for me, it's not quite a personal investment vehicle, but it's run. So if you start off, the benefit of a closed-end fund is you should not need to worry so much about getting absolute precise timing correct. And you can take advantage of opportunities that may take a period to unfold. I mean, that's what the closed-end structure should give you. So it allows you to have the patience to wait for things to come to you. Now, as we've said, there's a high degree of skepticism about valuations, so we don't need to get dragged into any of that. Interestingly, the most frequent investors we've seen investing have actually been professionals in the financial industry. People that we speak to who are actually in the trade, if you like, have been probably the newest investors into the trust. It's not been heavily marketed, and there's some reasons for that, but we're going to be stepping that up because we are, as indeed is the board, cognizant of where the discount is. And although discounts have widened generally, for a trust of this nature, it seems to me to be too wide, which to me makes it a bargain and why I continue to invest in it whenever I can. So I think the investor who doesn't want to have to make these decisions, this is what we're doing, this is what we're doing with our savings. We're not required to invest in anything. There are lots of trusts around, very well managed, but their mandates say you must be fully invested or you must be in this type of equity or this industry or this country. We don't have to do any of those things. So we're not mandated, nor are we forced either directly or indirectly by pressures to do that. So if the investor that thinks we may have some skill set in delivering against that, this is a trust that has the flexibility to go from arguably one of the most defensive around at the moment to potentially being one of the most heavily invested when the time is right. You just don't take on risk when valuations are high. You're not getting paid for it. John Templeton used to have something he called the Yale method. And he basically, as things got more expensive, it's as simple as he disinvested and then we got cheaper put money back in. And it meant he didn't get caught in the severe downturns of markets. But when markets were sort of going exponential, you would lag. That's just what it does. But I remember with Sir John, his happiest days were when markets were falling and he had cash to invest because he was able to take advantage of the opportunities. And to us, it's common sense. And then the sophistication comes in where Alan was starting to talk about is how do you create that environment whilst also giving you the chance to have returns during the negative periods. And that's where Alan in particular skill set comes in to help in blending a portfolio to give you that right, the appropriate kind of risk reward profile.
Before we just move on to that, investors will be looking at some of the other trusts in the flexible sector, such as the defensive ones, personal assets and capital gearing, and they have more of an absolute return mandate. What you're doing is you're similar in one sense, but you're different in another. Would that be how you would describe it?
I think so. The way I look at it is we wouldn't want to put a constraint that says we'll never have the asset value go down in any 1 year. You want to be willing to take that risk when the rewards justify it, but you don't take it when they don't justify it. So you're not structurally going to be positioning the portfolio so in any 1 year it never goes down. We are at the bearish end in the structure, as you know, with the size of the long short fund and the level of cash and so forth. But we actually want the day where we can go to the opposite end of the spectrum and be aggressively bullish. Does that mean that markets, even if they're cheap, can't fall a bit more? Sure, but we're not willing to give up the kind of level of returns that you can get in those markets for a kind of annualized protection, if you like. So when you get paid for the risk, you should take it. It's just you're not getting paid for it just now.
So the other difference then between you and some others is, as you say, you're currently trading on quite a wide discount. And that is maybe partly because it's a relatively small trust, just over 100 million. And I guess some people will be concerned about liquidity. What would you say to those people?
It's a fair question. I don't see the discount widening significantly from here. I mean, if you look at the disposition of assets, given the levels of cash and where the investments are, to have a wider discount than where we are, it shouldn't be that level of illiquidity premium, I don't think. But it's a fair point. It's not highly liquid. It's an investment you want to hold to preserve and grow your wealth over the long term. It's not one you want to be trading in and out of. I think, whether it's hope or expectation, that as the story unfolds and some of the views we've held, I think, become more justified by events to a degree that happened a couple of years ago, I think we will be in a position where we'll be able to grow the trust and the discount will come in. But we want to maintain the closed-end. We don't want to turn it into a pseudo-open-ended fund by constantly trying to manage the discount at this stage of its evolution, because we want the protection that gives you to allow you to have the patience to do the investment you want to do to take advantage of what's happening.
It's fair to say, I think, that the last 4 years, looking at the last 4 12-month periods, you have delivered a positive return in every of those 4 periods on an NAV basis. Tell us about then what is in the portfolio and some of the things that are different from other portfolios that people might be looking at, similar type trusts. So in particular, you've got this long-short vehicle. Tell us about that. What role does that play in the portfolio and what does it do?
I think probably the best way to think about the portfolio is a series of different exposures. So the different groups of stocks, different groups of exposures that have their own individual reasons to be in the portfolio because we think they'll make money and that hopefully fit together. And then, as I said before, the sort of overriding view is that we want to not have the portfolio's performance overly exposed to global valuations and a pro-cyclical economic view. So we've tried to combine these exposures in a way that means that we capture interesting returns from individual exposures, but where the overall macro and valuation risks are managed. So where we're taking valuation risk is in quite specific areas like defense stocks, like Japanese equity market, for example. We're big fans of income. I'm very aware of the fact that half, if not more, of the total return on equity markets over time comes from dividends, for example. But where you mainly have to go today in order to get high income from equity securities is in cyclical stocks, and we don't want that pro-cyclicality. So we have a big chunk of portfolio in money market and term deposits because they're yielding 5-odd%, the same as sort of high yield equity, but without the equity beta risk. The long short exposure that you referred to is a particularly useful lever to be able to pull in the portfolio. It's a particularly specialist equity long short strategy. So it's simple in the sense that it's just equity long short, but it's small cap, relatively low net exposure, so little market exposure. And in simple terms, it's long good companies and short the capital of companies that the portfolio manager expects to burn cash and ultimately go out of business, or at least fall very significantly. Very unusual in that it's deep fundamental long term. It's not short term in orientation at all, very much aligned with the way that Sandy and I think, managed by a portfolio manager that we've known for many, many years. And actually the strategy was put together at Templeton when Sandy and I were there. So to be exactly the exposure that we wanted, managed by exactly the person that we wanted managing it. And you can think of it as a beneficiary of attrition of good versus bad. And over large parts of the last 10 plus years, this kind of strategy would have been very difficult because low interest rates meant that corporate failure was relatively rare. But in any kind of normal environment, capitalism means bad companies fail. And certainly overpriced bad companies tend to go down over time. So this is a strategy that we think can make 15+% per annum returns over the long term, regardless of whether equity markets go up or down. But what it really brings to the portfolio is the potential for very significant absolute returns when other parts of the portfolio are really challenged. So when the sort of long equity risk in the portfolio is under pressure because markets are falling, long short should go up significantly. The income component of the portfolio should be largely fine, and other parts of the portfolio will help to sort of prop up the overall risk profile. So it's a key part of how we're trying to achieve that objective of not having broad equity market correlation at the moment in a portfolio which is almost exclusively outside of cash and money market funds invested in equities.
So that accounts, I think, for about 15% of the NAV, and you've got around a third or such in cash and similar instruments. And then apart from that, you've also got another fund. What role does that fund play? That's the Volunteer Park Capital Fund. What does that do? Why have you picked on that? That amounts for, I think, getting on for 8% or so of the portfolio.
Again, it's a very specialist strategy, not the sort of thing that would be available in, for example, an OIC or a UCITS. So it's taking advantage of the longer term nature of an investment trust. It owns a financial interest in a number of private capital fund managers, and it structures the investments with the underlying managers in a way that means that the probability of losing money is very low. So you can kind of think of it almost as secured lending, even though it's an equity strategy. So we're essentially trying to capture a 15% per annum internal rate of return with as little risk as possible. It invests with small to medium-sized private capital fund managers, providing them with financing for their growth, but largely securing that investment against tangible assets of those businesses. So hence the idea of thinking of it as a sort of secured lending type strategy. We're giving up some of the upside, if you like, that you could get from a traditional private equity investment in order to maximize the downside protection. And again, if you think the long short strategy can do 15+% per annum return, hopefully over time, and make a lot of money in a correction. The VPC fund, we think, is a 10 to 15% per annum, pretty much regardless of what happens in the broad market. And it's hard to get into anything below high single digit returns if everything that Sandy wrote in his book, The End of the Everything Bubble, is correct, which might sound a little counterintuitive, given that one of the things that we're bearish on is the private equity industry. And this is a private capital fund, but it's all in the way that you structure the underlying investments. So again, I think hopefully these examples reinforce what I was saying before about, we are bearish, but we are looking for return in everything that we invest in. We're just trying to get it in ways that aren't dependent on markets going up or economic growth spontaneously improving. Obviously, equity markets do tend to go up over time. Certainly market cap weighted equity indices tend to go up over time. So that can be a bit of a free lunch, if you like. So you could argue we're making life harder for ourselves if we were like this all the time. What Sandy was saying is that we will rotate the exposures over time. And when there is a free lunch on equity market valuations, we'll quite happily take it.
Maybe one other thing to add, Jonathan, is that, you asked about the fund and what it does. And, in some ways you could almost liken it a little bit to like a small family office. The relationship with Goodhart and Alan's relationships and those from other people in the Goodhart team gives us access to vehicles like this, either directly or indirectly, either in-house or externally, that I, as an individual investor, would not be able to access, either because of a knowledge base or because of the structure of the funds, that allows us to build portfolios with these kind of profiles. Because the closed-end structure gives us the flexibility, the tie with Goodhart gives us the resources, the knowledge and the network to be able to implement against the views. So the change in the investment policy of the trust was one thing, but you still have to be able to implement against it. And, you need to recognize your own limitations and then where you can find the skill sets that you don't have. And that, for me, was one of the reasons for the tie with Goodhart, is what Goodhart brings to the party, in my mind, is very significant in terms of both portfolio structuring and accessing opportunities. As I say, I don't look on it as my family office. That wouldn't be appropriate, but it gives us the ability to do things that you just couldn't do on your own. And also it gives you the ability to do them at a much lower cost. We didn't mention that, but the expense ratio is around 1 or under 1%, doing some of the things we do, because some of it's done at low cost, which frees up the resources to do things that cost a bit more. So we work very hard on maintaining a low expense ratio whilst still getting exposure to more exciting areas.
So let's talk about what actually happened in last year, calendar year. You published your annual results recently, and you made a small positive NAV total return. So which parts of the portfolio worked and which parts didn't work so well last year?
I think over 2 years, we're reasonably comfortable with performance. In 2022, honestly, we did a little better than we might have expected. And in 2023, a little worse than we would have expected. But the aggregate of the two doesn't feel inappropriate. And I think certainly over 3 years, performance compares pretty favorably with equity or multi-asset peers. And the thing that really differentiates it is the absolute volatility, which, we don't target absolute volatility, but to the extent that that is supportive of trying to manage a strategy that doesn't have significant downside risk, the low volatility is certainly a feature. And to put it in context, it's something like half of the typical multi-asset strategy and closer to a third of equity market volatility over the last 3 years. So risk-adjusted return has been attractive. in 2023, in simple terms, we didn't have enough US tech in order to perform better because it was a very narrow market. And the two things that we could have done that would have obviously improved return would have been buying US tech or buying bonds. And, the rearview mirror is obviously a wonderful thing for identifying the things that you could have done. It's actually more annoying than that in some ways because Sandy and I were talking about both of those things at the time. In terms of sort of tactical opportunities, they were reasonably obvious. I think the challenge with investing tactically in things that you don't think are attractive on a longer term basis is if you get your timing wrong. It's sort of analogous to picking up the pennies in front of the steamroller. If the steamroller's going too fast, you get in trouble. And so Sandy and I were talking quite actively with each other about, should we be buying bonds? Could we squint and force ourselves to take on a little bit of technology risk? And we decided not to because we're very confident in the longer term and we focus on the steamroller, not the pennies type mindset. But it is galling. We don't like lagging markets as much as we did in 2023. But then again, in 2022, we did better than we could have hoped for, really, with a significant double-digit absolute return.
Yes, I think there's a couple of things there, Jonathan. One of them, obviously, is calendar years can be a bit of an artificial period for us. What are the rolling returns looking like, and the profile of them, I think, is appropriate. We did expect a rally, and I think you may remember we wrote some pieces about the transitory nature of some of the inflation and how markets would likely react to that in a positive manner on the basis that we could go back to the post-GFC world of very low interest rates and assets always going up, which the kind of vehemence of the lift in equities surprised me a little bit. I thought there would be a rally, but not of that magnitude. But I think it's hard for me to see how it can run much further given the territory it's already in. So there was a bit of an opportunity to do something, but as Alan said, it was largely tactical. And you don't want to stray too far from where your underlying views are, and they really hadn't changed. And there's no sign of structural improvements in productivity growth or any of the things that you would need to say the entire thesis is wrong. Notwithstanding that AI will be important, but it'll be important the way most technological developments are important, that in the short to medium term, it's probably a negative and then it becomes a positive. And as Alan said earlier, all the structural impediments, the kind of inflection point we passed, and particularly in demographics, but also in trade relations and so forth, they're all still negatives. So against that backdrop, we didn't make significant changes, although we have done a little bit of rotation more recently, not into tech, but into other areas where some opportunities have seemed to have emerged.
So I was going to ask you, so far we're now in middle of May, how has the portfolio been performing so far this year?
The NAV is up. It's lagging a bit, but not massively so. There were one or two opportunities. We put a position of Jet2 in. Obviously, as you know, airlines are operationally geared, economically geared, and typically financially geared. So you need to be very careful about it. But there are some structural things going on that made that look attractive to us. And that was a different profile of equity to what's been in the portfolio, but justified by its specific circumstances. So, I look at the performance this year in NAV terms, and I'm reasonably comfortable with it. I remain comfortable with the structure of the portfolio. The day I'm looking for is the day when all the things start to fall and we're in a position to cherry pick exciting investments at low valuations. It's easy to think that day will never come, since from 2008 onwards, or after the run-up post-GFC, we've had inflated valuations. But what goes around comes around. They will come back. I'm very confident about that. And the beauty of the trust in our position is we're not going to be pressured into doing things we don't think are appropriate. The closed-end structure helps us. We're doing what we think is right, and we're going to stick to that.
If we were just trying to position the portfolio as a bear market fund, it would look very different. There are plenty of investments in the portfolio that are long and looking for upside from a long-only investment. Japan exposure, for example, the defense stocks, some of the individual positions like Jet2 that you just mentioned, you would look at those and think that you were optimistic, going for upside return. I think that's true about each of those individually. It's just this other element, isn't it, of how we try to structure the overall portfolio to not be taking the big macro and valuation risk that makes it a little different, if you like. So I guess if we're wrong, and it takes a lot longer for our views of what's going to happen to materialize, the expectation is that the trust will still post a healthy absolute return over time. If we were just betting the ranch on markets collapsing, this would look very different indeed. And we could do that very easily, but we don't feel it appropriate to take that risk. And the timing and the sequencing of when things happen is incredibly difficult, isn't it? But we're just not getting the signals from our research in markets to make us think that we should be rotating into more pro-cyclical risk, are we? And the most recent thing we've done actually is sell our large cap Japanese stocks to buy a small cap fund, because larger companies have become really quite expensive. Just now, everyone seems to be getting really excited about Japan, and it's just not cheap anymore. And the risk return changes, and it becomes much more skewed to the downside. That's when we change gears and go in a different direction rather than get long the momentum.
On that point, though, why would you then go into a small cap fund then? Just because the valuations are more attractive? You still think there must be a rationale for Japan there as well?
Yeah, there is. I mean, Japan's an interesting market. I think there's a very long-term, 20-year plus tailwind to the value that is unlocked in Japan from corporate governance reform, which is quite hard to understand from a Western perspective, because most people here don't really have expertise in Japan and couldn't quite believe how inefficient a lot of companies in Japan are, even if you sort of explained it in detail to them. But we think there's a long tailwind to investing in Japan, but there will be cycles within it. And recently, Japan is hot and Japanese funds are growing. The marginal investor is US institutions. All the broker events in Tokyo are full. Hotel prices are expensive again. Beer prices going up. But smaller companies are just a lot cheaper and are actually more exposed to the things that we think are really interesting in Japan. So the asset value investors, Japan Special Situation Fund invests in smaller micro caps companies that have very high levels of either net cash on their balance sheet or cross shareholdings, Keiretsu investments in other companies. And as balance sheets in Japan normalize, as companies behave more like European and Western counterparts and run leaner and right-size their balance sheets, the value in those kind of businesses will be unlocked over time. Smaller companies are also typically owned more by domestic retail investors than institutions. And you've seen what's happened to the yen in the last couple of years. If there was a reversal in the yen, there's a reasonable probability that the smaller cap part of Japan would be less badly affected than exporters that tend to be larger cap, where their earnings are clearly more at risk or have less of a tailwind, if you like, from a weak yen if that reverses. So there are a number of elements to why we've been attracted to the smaller companies space in Japan over the long term. We don't want out of Japan. We just don't want to be holding on to companies at the point the American investors step in and buying things that are trading at very high valuations.
So you mentioned Japan, you've mentioned defense stocks a number of times, you've mentioned the money market funds and the income you can generate from cash and liquidity. I'm just looking through your main categories again, and we mentioned the two specialist funds. You've also got a characterization of mispriced volatility. What is that about?
The origin of it, actually, being honest, was we lagged in the back end of 2023 more than we would have expected when markets were overexcited, because some of the parts of the portfolio that we thought would catch more upside than they did. So oil stocks, for example. So we were trying to think about how we could get a little more exposure to stocks that would perform well in a more kind of benign environment, a more sort of optimistic environment. But again, without directly betting on economic improvement or taking the valuation risk. So that's really what the mispriced volatility exposure is about. There are sort of idiosyncratic reasons why Jet 2, we think, has less downside than an airline typically would have in an economic downturn, but it most likely performs well in an environment when things like US tech, etc., are doing really well. So hopefully it's a sort of heads we win, tails you lose type position. And Alibaba is just exposed to some very different things. But again, a thawing of US-China trade issues, for example, could well help that stock a lot. I don't think that exposure will ever be, for the time being, a large component of the portfolio, because normally in order to get stocks that are exposed to that kind of upside, you have to take on the pro-cyclical risk. But we felt that the calibration was a little out. We did worse in December and November last year than we would have expected in that environment. So we've given ourselves a bit more diversification in some stocks that can catch more market upside. And that's partly a reflection of the confidence that we have, for example, in the long-short exposure, where just how much firepower that brings to the portfolio in the negative scenarios.
One of the things that you mentioned at the top of this segment, you said there's a need for more communication. It's quite a difficult thing to get across, perhaps to some investors, the nature of his portfolio and why it's structured the way it is. It's couched in terms that professionals may understand, but private investors might find a little more difficult. We've talked about those two specialist funds, mispriced volatility, and so on. What do you think you can do in terms of communicating how this trust behaves in future?
I think most of it, Jonathan, is probably shoe leather. I mean, you just need to go and see the shareholders or put yourself in a position where they can ask you questions, because it should be a simple explanation. When you're not getting paid for risk, when the returns aren't there, don't take it. And when it is, do take it across all asset classes. And that's what we're trying to do. We're not structurally at one end or the other. We will be at one end or the other of risk-reward profiles, depending on how we see the underlying conditions. And when it's not appropriate to be at one, we'll move to the other, or back and forward across. And that's the simplest explanation, if you like. The chart of what existing valuations are, and therefore what risk you should be willing to take on, is what drives us. The bit that's complicated isn't the right term, but where you're obviously trying to be thoughtful, and it is understanding both where the opportunities lie and then how to access them. The problem for investors, it's not necessarily a problem, but a lot of the thinking is, I'll buy this trust or that trust, and it's clear and it's simple, and it's a go-go growth trust, or it's a deep value trust. And we're saying, well, we could have elements of either of those depending on what we see. And if the investor wants to make all those decisions themselves, that's entirely appropriate, and that's absolutely fine. If they want to subcontract to somebody to make them for them, then that's what we are trying to do. And not a sales pitch. We're trying to manage our own money. The pitch is like, we're trying to be open and transparent about what we're doing. We're being very vocal about where we see things. And if you think there's any track record or history in us being able to deliver against it, then maybe we can do that in the future and give you the sort of returns you want without taking on the very high peaks and troughs that come with specialist vehicles. What I hope is, if what we're doing continues to pan out, we'll grow a group of followers who we've had a dialogue with, who do understand what we're doing and feel it's appropriate for part of their wealth to be in a fund of this nature. It's not like I'm trying to build a big business. We're trying to run the assets in a way that we think is appropriate, and we hope it might be appropriate for others, but it's self-managed. So, my financial interest in this is on the assets performing, because some of them are my assets. There's not an ulterior motive. It's not a sales pitch. It's a conversation.
What I take away from this is that when you launched the Global Opportunities Trust, or as it originally was, Edinburgh Partners Global Opportunities Trust, it was essentially an equities and cash approach. Now you've changed it because the world's changed.
Yes.
And I guess your business model, if you like, has changed as well. And it is a relatively low absolute risk. You made that point very clearly. And it'll succeed or fail on your ability to first read the markets correctly and then construct a portfolio accordingly to maximize in line with your kind of risk tolerance. Would that be a summary?
Yeah, that'd be a good summary.
So finally then, we've talked about the market conditions and so on. It is an investment trust, a self-managed investment trust. And you mentioned you like income at the moment and you're getting quite a lot of income on your cash. So tell us about the potential for yield. There isn't a particularly high yield on this trust. Is that ever going to be a significant factor? And are you ever going to use gearing, pure vanilla gearing, I should say, at the investment trust level?
So taking the gearing question first, hypothetically, yes. If we go to a position where everything's really cheap and we can get debt cheap and we can enhance returns, then we certainly would. When we had the financial crisis, we looked at taking on debt to take advantage of some of the opportunity that was there. But you'll not be surprised to hear it was hard to get debt during a financial crisis when the banks were in trouble. To get lending from a bank at the time you wanted it wasn't easy. And I'm not sure necessarily see a repeat of that. And then secondly, the size of the trust meant issuing a debenture or something just wasn't cost effective. But the short answer is, if assets are really cheap and debt is underpriced, then yes, we would take debt and put some gearing in place and try and enhance the returns that way. It is one of the big advantages of a trust of this nature. And then I think the answer on income is similar to the one we gave when we launched the trust, which is that we don't want to be constrained in what we do by the need to generate income. We've seen many times in the past stretching to get income, forcing the structure of a portfolio in the wrong direction. Now, I know you can pay out capital, but we're not great fans of that. So there'll be periods when income could be high, and then there could be periods when it's low. It just depends on where the valuations lie and the underlying assets. So it's not going to be an income trust of that nature, I don't think.
That was Sandy Nairn and his colleague Alan Bartlett talking about the changes that have been made to the portfolio of Global Opportunities Trust and the outlook for where this specialist vehicle is or may be heading. So it was a timely opportunity to catch up this week with Richard Watts, who is one of the co-founders and current co-portfolio manager of Chrysalis Investments, ticker CHRY, the early stage private investments company, been listed since 2018. And has had, I think it's fair to say, Richard, something of a roller coaster ride over that period. You've been up and you've been down, and the shares are now beginning to recover from the lows. You launched at around £1 and went to somewhere north of £2, and then sunk all the way back to 50p, and it's now back up at around 80p, looking at the quote this morning. You've had a couple of moves as well in that period. You started at Merion, which was an independent boutique firm. That ran into some difficulty and got sold to Jupiter. And now, as of last month, you are now back being managed by a boutique firm, which includes yourself and your colleague Nick Williamson. First of all, could you just clarify for the listeners exactly what the current position is? So you are now entirely free of Jupiter and operating as an independent entity, is that right?
Thanks, Jonathan. So, yes, that's right. So we're now a completely separate entity to Jupiter. We left Jupiter at the end of March of this year, and from the 1st of April, our new partnership took over management of the Chrysalis Investments portfolio contract. So since that date, yes, been completely separate from Jupiter and our own banner, effectively.
Can I ask you, without being too inquisitive, what are your feelings about all that? You've been on this, as I say, journey in and out of a larger company and back to being an independent entity advising the portfolio, as you say. What's it been like from your perspective?
Yeah, look, I think probably roller coaster was a good way of describing it, Jonathan, where we started life. Nick and I launched Chrysalis in late 2018. And I'd say probably the first 3 years or so, very successful. Share price performing very well, portfolio performing very well. 2021, I think, just a sell-off in growth stocks and just the investment environment for private growth and fundraising has just been a lot more challenged. It's just been a lot more difficult for companies to raise money. And so I'd say the last few years, the focus that we've had very much been essentially working with our portfolio companies to put them in a good place, to make them more self-sufficient, stand on their own 2 feet with reduced requirements to raise external capital. And so that's been the focus the last few years. And that's been more difficult in terms of the NAV per share declined, reflecting the decline in growth stocks or listed growth stocks. So we mark to market the portfolio. I think, though, we feel pretty good about life. The last year or so, there's been a lot of hard work has gone into the portfolio companies, as I said, to put them on a more sustainable footing. I think as well, that's kind of coincided with our move away from Jupiter, running a listed investment trust that invests in private companies within a listed asset manager presents some challenges. And I think we kind of came to the conclusion that spinning out from Jupiter was a way of essentially creating an environment that was probably more suitable for the product that it is. Yeah, so I think we feel pretty good about where we are and we're on the front foot and looking forward to building the business.
So just looking back in retrospect, would you have done things differently if you'd known what was going to happen?
Look, I think, John, you always learn the lessons, and I think when I look at the portfolio, I think the lessons, look, we've been through a number of challenging situations in recent years where we've had to work with management teams to restructure businesses, where some businesses have required more capital and we've put more capital into those businesses. And I think we've learned a lot of very, very valuable lessons about how to structure investments and how to structure deals. So yeah, look, I think the reality is you can always sit here and say you would do things differently. I think I'm trying to be more positive than that and say, look, I think we've gained a lot of very, very valuable experience. We've learned a lot of lessons. And I think it's about taking all of that on board and making sure that going forward that you're kind of deploying the lessons and the knowledge that you've picked up and acquired over the years.
I guess the point that some shareholders might make is that you've come through a difficult period, but the shares are still underneath where they were when you launched the thing 5.5 years ago. And obviously they had a chance to make some money at the top, as did you and Jupiter in particular. And there's still quite a lot of work to do to get back. If people have held onto the shares all the way through, they're not going to be particularly thrilled about where they are. So they'll be pinning a lot of hope in what you can do from here.
Yeah, look, I think that's fair. And I think Nick and I are very conscious that we've had a lot of shareholders that have showed a lot of support. Many of them have been in since launch, as you correctly say. I think, though, look, if you actually look at the share price and where the share price is, much of the share price weakness reflects the discount to NAV. And from probably most of the first 3 years of Chrysalis' life, we were trading at or just above NAV in terms of the share price. So, we were holding a very modest premium for most of that time. And then from the late part of 2021 onwards, when markets sold off and second line listed growth stocks sold off, we went to a discount. And all of that, I'm afraid, Jonathan, has kind of coincided with, I suppose it's well documented, and you read the press pretty much every day talking about the challenges of the London market and the lack of liquidity and the lack of IPOs and asset allocators allocating away from the UK and moving towards more global mandates. And the simple fact is, liquidity in the UK market has been very, very low. And of course, we've gone to a discount and is trying to unwind that discount. So I think we break this down into steps, really. And the most obvious way of getting the share price recovering is to reduce that discount. And then, of course, alongside that, we want to grow the NAV. And so we're working very hard on both of those things. And just in terms of the discount, we announced the capital allocation policy, which shareholders voted on back in March, where effectively we said that we are committed to returning £100 million to shareholders as soon as we get realisations. And we did announce a likely realisation in December of last year, which we recently updated that, we remain optimistic on the progress with that realisation. Obviously, sometimes things take time. But the reality is we think increasingly we are likely to move towards a phase of having realisations into the portfolio. And that gives us the opportunity to put that £100 million, we said a share buyback, but it could be another mechanism, but to put that £100 million share buyback and start it. We also announced recently that we were exploring the possibility of taking on a modest or a low level of gearing into the portfolio with the view to accelerating that capital allocation policy. So I think we're trying to work very hard, really, Jonathan, to try and get liquidity into our portfolio that would enable us to initiate the £100 million share buyback.
Obviously, the whole strategy was to invest in unlisted entities. And one of the reasons for that was because there were fewer IPOs and the market was shrinking and so on. And there was a lot more money going into private capital. But that still left you with this problem of how to actually realise value from the portfolio if it's not through coming back to market. So there's a bit of a paradox there, isn't there? I mean, you need the UK market to do well in order to realise the value of at least some of your portfolio. So that's a sort of paradox that has not yet been fully resolved, if I can put it that way.
Yeah, and I think it's a good word, paradox. Look, I think the reality is the reason we set Chrysalis there is because we saw this trend coming. And I think we were pretty early recognising this. I'd run listed equity money. I joined Old Mutual, which became Merion, now Jupiter, in 2002. And I've been managing the mid-cap portfolio, the original Old Mutual UK mid-cap portfolio, since 2009. So I was immersed in the UK equity market. And we just recognised the challenges for the UK market where it just wasn't seen to be a very attractive or desirable place by many people to want to list and IPO their companies. And it's not just that, it's also about the growth in private markets. And it just gives companies an alternative option. They don't need to IPO. So lots of dynamics at place, but essentially all being reflected in just a lack of IPOs coming into the UK. I think we had the foresight to recognise that. It also meant for us that when we set Chrysalis up, we didn't have a mandate just to invest in the UK. We gave ourselves the mandate to invest internationally. So you look at the portfolio, and I suppose Klarna is a case in point, and Klarna, and I don't know any more than the next person in that regard, but the rumours are that it will list in America on NASDAQ. And we've got other businesses in the portfolio that are based in the US, like Brandtech, for instance, very likely to be a US IPO when it does list. So I'd say it's not just about the UK IPO market for us. Look, as long as the US IPO market remains vibrant, and that market been picking up recently and it's been better. And I've always said for the best businesses, IPO is always an option, even if market environments are difficult. So I think, look, we're not worried about the state of the UK IPO market in the sense of, is that a block for Chrysalis getting realisations in the portfolio? I don't think it is. I'd also say We talk a lot about IPOs, Jonathan, but the reality is there are other routes of exit here, and strategic, and i.e. trade sale. Trade sale, that the M&A market has picked up very strongly. And obviously you've seen this in the UK context, dark trades very recently, for instance. So when I first started out my career, a wise old person that I used to speak to on the analyst side, so when the management teams are building businesses, they should really build something that someone else wants to buy, right? I always took that away from me thinking, essentially, if you invest in businesses that have a lot of strategic value, someone will want to buy that business off you, right? So I think for us, when I look through the portfolio, do we have that type of company in this portfolio? And the answer is yes. Through the entire portfolio, we've got businesses here that essentially the blueprint that we put into place in terms of investment philosophy was that we wanted to invest in tech-enabled, disruptive businesses. And to be honest, it was more disruption. And the fact is, disruptive companies use technology bluntly because you basically can do things much more efficiently and much more effectively. And because these businesses have been built from scratch, they just don't have any of the legacy issues and the legacy cost base and the challenges to solve, etc. So when we invest in Starling Bank, for instance, here was a business that was built on modern technology, cloud native, API driven. It's very, very efficient. So the cost per account is significantly lower than it is for the incumbent banks. And that gives you a big advantage. It gives you a massive opportunity to disrupt the banking sector. And that's what you've seen, with Starling and others like Monzo, for instance, as well. They've taken an awful lot of market share in a relatively short period of time. And can they keep on doing that? And we believe they can. And something like Starling, can they sell their technology to other banks around the world, which they've started to do with Engine? And if you have that type of business, it is very attractive. We could IPO it. Would someone want to buy it off us? Maybe. And so for Starling, I think IPO is probably the most likely exit because we're on a journey with this business for a long, long time. And so I think don't underestimate the power of disruption in the sense of it gives a tremendous ability for these companies to grow very quickly for a long, long period of time, but also makes them highly attractive to other companies and other investors who want to buy them. And so I think that strategic value focus has been quite important for us.
Given all that then, given where the company is at the moment, what is your thinking about what you might do with these holdings? Because obviously on the one hand, there's some pressure to realise some value, to demonstrate the NAV and to raise some cash. On the other hand, as you say, these are businesses that could go on growing for a long time. If you did IPO, say, one of your biggest holdings, would you be hanging on to the shares or would you be trying to unload them all to get the cash? What would be your thinking?
I think the basic thinking is a company IPOs, and we should at least look to take our original investment cost off the table and then a portion of the realised profits. And that portion, I think, frankly, depends on the valuation of the business at the point of IPO. So if we end up with a business that trades very well post an IPO, you would look to take more off. If you have another business where you think there's still an awful lot of upside, you look to run it. And I think we've always been quite careful to explain that to shareholders, that you shouldn't be in a position where you're forced to sell out your entire position on the first day of an IPO or within a few days or a few weeks of an IPO if you think there's an awful lot of upside left. So it's about finding that balance. You can only really answer that question on a case-by-case basis as and when it happens. And it becomes a capital allocation decision at that point. And what we've said in our capital allocation policy is, look, if we are at a very wide discount to NAV, then it makes perfect sense to buy back shares and buy back your own portfolio. If you're not at a discount to NAV, then that gives you the opportunity to redeploy into new investments. So that's how we've explained it to shareholders at the continuation vote. And look, we've got a lot of support for that philosophy and that strategy. There are other ways, though, Jonathan. It's not just about like an IPO. It's not just about trade sale. Can we get the portfolio into a position where the portfolio companies are very profitable and grow very quickly? And if we do that, that gives the opportunity, of course, for cash returns from the portfolio companies in time. And of course, we could use those returns then to obviously either deploy into new investments or to do share buybacks if we're at a big discount. So I think everything that we've done in the last few years, we've been laser-like focused on making sure that these portfolio companies are getting themselves into a position where they become profitable. If I look at the portfolio, I think where we are now is it's not particularly capital intensive. So in terms of our expectation for how much more money do we need to put into these companies? And I think, again, coming back to the discount, it's probably one of the reasons for the discount as well. People are trying to kind of figure that out. And we keep on saying it, but we don't think there's much left for us to do. But the point is, we need to demonstrate that. And the best way of demonstrating that to our shareholders is for them to understand that our portfolio companies are profitable and they don't raise any money. And I think Klarna is a great example. That felt very painful in July 2022 when they raised money at that deeply discounted valuation. But it was absolutely the right thing to have done, because what that raise did was allow that business to carry on growing at 20 to 25% in terms of revenue growth, but it's driven that business to profitability. And so, we are very confident that 2024 will be the first year of profit for Klarna, and 2025 should be much better again. I look at Starling Bank. When we first invested in Starling in 2019, it was a heavily loss-making business. And as we said recently, run rate profit in that business is £350 million today. So you've got to look at these opportunities, and we want the disruption, we want the growth. So we don't want to take decisions that constrain the potential of these businesses. But the reality is, when businesses have been in an environment where it was very easy to raise capital, I think maybe for some companies there was a belief that they could carry on running lots of losses and they almost go for the real aggressive kind of growth scenario. And of course, in a world where it's more difficult to raise capital, companies have to reassess and change their plans. And so we've been supporting our companies in recent years to do that. And we feel like we're almost at the very end of that process. If we do get an IPO of one of the larger holdings within the next 6 to 12 months, again, that will drive a lot of liquidity in. And if the underlying portfolio is in a position where we've driven these companies to profitability and they are well funded, that feels like a really good place to be. And it means that we can execute the capital allocation policy and start returning £100 million to shareholders. Hopefully that unwinds the discount to NAV. And alongside that, hopefully we are growing the NAV. And I think if we do all of these things, I think we'll come through it thinking, okay, that was a roller coaster. That was a lot of hard work, but that's what we're here to do, and hopefully drive a really good outcome for our shareholders.
So just tell us about the cash position then. So you have some liquidity at the moment. You've talked about possibly taking out some short-term gearing to help that. But as you say, would it just take one significant realization to put you onto a different path? At the moment, are you having to watch every penny, as it were, because you may need to fund more in some of the investments you've got, unless there's a realization elsewhere? Is that what you're saying?
Yeah, I think we've been managing our liquidity very carefully for the last 2 years, okay? And so we recognised that the portfolio was going to require follow-on investment. And to be clear, we never hid that from anyone. Shareholders, when you invest in these businesses, there's always that understanding that there is a requirement for capital at some point in the future. And so it's been well understood to us, the funding needs of our companies. We either sit on the board or we observe the boards of the vast majority of our investments. So we understand their capital requirements. So in terms of managing our own liquidity, where we are now, we have about 26 or 27 million pounds of liquidity, as we announced in the last NAV update. And we said that's enough. Even if we don't get the likely realization, that is enough for us to do what we need to do. Don't get me wrong, we'd like a bit more, but hopefully we'll have the likely realization. And when what we said there is that would take us through £50 million of liquidity. If you look at our biggest assets, the one that is most likely to IPO first is Klarna. They've been very public about this. The founder, the co-founder, has been in the press and on TV a number of times in the last 3 or 4 months talking about an IPO quite soon. And, there was stuff out there last week, or earlier on this week, talking about Q1 of next year. So look, Klarna, in terms of our carrying value, is a £100 million position for us. If that business IPOs, that alone funds the capital allocation policy. So look, I can't make Klarna IPO next week, but, it feels like it's coming and it feels like it's closer. And by the way, look, if it doesn't happen, there are opportunities to get secondary liquidity in a business like Klarna. People always want to buy the best companies. And if you actually look at the private market backdrop, Secondary sales are increasing. The market is coming back alive. I honestly believe, Jonathan, we'll be looking back in 5 years and asset managers need to have a private market capability, bluntly. This is where the market is going. This private market is going to be huge in the next 5 to 10 years. It's big now and it's going to get bigger. And people are going to need to have access to this type of product.
When they announced these new arrangements, the continuation vote was passed and the new arrangements, including your role, has been changed. The board talked about you've implemented a significantly enhanced risk process. What is that all about? What was wrong with the risk process before and how is it being enhanced?
So look, when you look at the team, effectively the team was a team within Jupiter. And I think Nick and I realised from the very early days of Chrysalis that it needed its own resource, not just investment talent, but the things that go around managing this type of portfolio. So legal capability, finance director, all of the ESG, all of these kind of activities that are really important. And in a listed asset manager, those capabilities typically are centralised. You'll have a central team. And it doesn't work that well for a product like Chrysalis because there's so much going on in the portfolio. There's legal documents to be signed every week. So we needed our own legal person. We then brought in a director of finance. We get so much information coming through from these companies. And effectively, the risk governance framework was how do we take that information and present it to the Chrysalis board in a way that is digestible, but actually gives the Chrysalis board and ourselves how do you monitor the portfolio? So every quarter we produce 160-page risk pack, and that goes into each investment, the liquidity profile of each company. Does it need any money? Does it not need any money? All of the KPIs, the milestones, how is the business trading? What's actually going on in the company? It's a whole host of things that go into that risk pack. And that is something that we've developed over the last number of years on the team. And so that framework now is in place. It also means structure with IQEQ and the way it works there. So essentially IQEQ, Chrysalis Investment Partners LLP, which is the name of the LLP that Nick and I have set up to manage the Chrysalis contract. We are an appointed representative of IQEQ's G10 subsidiary. And that gives us the regulatory authority and approval to obviously manage that portfolio. They have their own risk team that monitors everything that we are doing. So there's that layer of risk management and governance and oversight there as well. So look, I think what we have now is very robust. It works very well. It's taken the things that we built and developed over the last number of years. And on top of that is putting an extra layer of governance and oversight. And then, of course, you have the board of Chrysalis.
One other question I think I should put to you is, do you think of Chrysalis as a complex investment?
Well, I think we try not to make it complex, Jonathan. So I think for me, I always kind of felt that it needed to be something that people could understand. And that meant for us somewhere in the region of 15 investments. And 15 investments in businesses like Klarna, like Starling, that people hopefully in time would understand very well what they were. And where we could give lots of information about those companies in terms of profitability, revenues, growth, etc. So when people look and choose, or if they're looking to invest in Chrysalis, they understand what they own. So I'd like to think from that sense, it's not that complicated, really. This is not a portfolio that has 150 investments that no one can really understand what's going on. So I think, though, from a risk perspective, people need to understand here that there is more volatility in this type of strategy by the nature of what it is. And so from that perspective, it is more complicated and complex. I honestly believe when you look at the secondary market and the private market, the market is starting to improve. Money is being put to work. You've definitely still got a situation where some investors have capital and some investors don't. And those investors with capital are trying to take advantage of this dislocation in the market. And I honestly believe now's the time to invest in this particular area because these are the best deals to be had, right? And over time, of course, as more capital comes back in, it arbitrages the opportunity away. I think those with capital are going to come out with this looking pretty good over the next 3, 4, 5 years.
If I can then finish by asking, when you started, did you have a mental idea of where you thought you might be able to get the NAV to over a period of time? You've had 5 and a bit years already, and the reported NAV is 147p. So I guess you would argue that's been a reasonable rate of progress, not fantastic, but reasonable rate of progress. Where do you think you'd like to be in 5 years' time? You have a performance fee and you need to get up to the high water mark of 225p or something like that, I think, again, to start earning that again. What are your realistic ambitions for this vehicle now?
I saw a chart last week, Jonathan, where had companies like Amazon, Meta and Uber and a whole bunch of other things on there. And the reality is 95% of the value that those businesses created was created after 10 years of existence of those companies. And so you realize, of course, that, we all want to invest in something and start something up and say within 3 years, we're going to make an absolute truckload of money. It takes time. Now, we've been going for 5 years. So we're a long way through this process. And of course, we've invested in companies that have been around more than 10 years. Klarna is a great example. I think that started in 2004, 2005. And so it's fascinating because I think what it's kind of telling you is, look, you do have to be patient here. But in terms of my ambition and where I see it, do we have a number of investments in this portfolio that are capable of being many multiple times return from the current level? And in my honest view, and I've said this very openly, the answer is yes, right? I wouldn't be doing this if I didn't believe that. And our job is to make sure that those companies, they execute properly and they don't lose out on the opportunity to become very large, meaningful companies. And so I kind of look at it, like Starling's a great example. It's probably got, a 3% market share in the retail current account market in the UK, 9% or so in SME. Lots of other categories where it's not in today, and then the ability to go and license that banking technology to banks around the world. And you've seen recent announcements on a bank in Romania where they've licensed the technology to a Salt Bank, in Australia where they've licensed the platform to AMP. And very recently, Sam Everington, who runs Engine at Starling, was talking about many other banks that they're in discussions with. And the reality is that becomes the potential to become an infrastructure play. And when you become an infrastructure play and you have a very profitable core bank in the UK, you create something I genuinely believe that the market will pay a premium valuation multiple for that type of business. It shouldn't trade on like what Lloyds Bank trades on, or NatWest or RBS. And, that's what we're trying to do. Can we create or help create businesses that when they do IPO, trade on high valuation multiples because of the nature of what they are, right? And if those businesses are growing very strongly, the two things combined will deliver a very, very good outcome for us.
So that was Richard Watts, who is one of the portfolio managers for Chrysalis, now managed by an independent firm rather than Jupiter.
Thank you for listening. The Moneymakers Weekly Investment Trust podcast is independently produced and edited and is listed on all leading podcast channels. You can also sign up at the website money-makers.co to be notified every time a new podcast is available. Please note these podcasts are provided for educational purposes only, and nothing you have heard from any of the speakers should be regarded as constituting investment advice. If you want more news, analysis, interviews and other investment trust content, don't forget to look at the Moneymakers Circle, available now for a modest subscription at the website.